Costing a product is one of the major decisions a company takes. Product costing is the process of tracking and analyzing all of the costs incurred in the production and sale of a product or service, including direct costs and overhead costs. Product costing depends on many factors such as understand the target market, target customer, fixed and variable cost behavior, volume to be produced and sold, and most importantly, the point where company will make no gain and no loss, that is called break-even point. Let's take a practical example. Assume it is the summertime, we are going into ice cream business. To make a single cone ice cream, we need three things: cone, flavor, and paper. The cone cost us $0.075. Flavor cost $1.69. And paper cost us $0.112. Total cost would be $1.875. The sales price of per cone would be $7.50. Total variable cost of cone is $1.875, that is our variable cost. Variable cost is a cost that changes depending on the number of goods produced or services provided. If we deduct our variable cost, that is $1.875 from the sales price $7.50, the result will be $5.63. Please note that $5.63 is not a profit. In fact, this is called a contribution margin. Contribution margin is the difference between the selling price and the variable costs. Total profit will come after deducting the fixed cost. Fixed cost is a cost that stays the same no matter how many goods and services are provided. For example, equipment cost, rent expenses, and employee cost. These costs are incurred regardless of the number of customers and need to be covered in the pricing. Contribution margin is used to cover fixed cost. Organization cannot make a profit unless they cover their fixed cost. Fixed cost often considered as overhead costs. Question: can this business be profitable? Well, it is depending on how many customers you expect. Number of customers trigger another question. How many people must buy a snow cone for us to be profitable? Let's move further into detail and understand more about break-even point. Break-even is the point where fixed costs are exactly covered, no gain and no loss. Break-even point is calculated by dividing fixed cost to contribution margin. Suppose you have fixed cost $11,000 per month. And contribution margin was $5.63 per cone. So, our break-even point will come when we sell 1954 cones per month. Mean you have to sell 65 cones on a daily basis and 8 cones in an hour. No business is open to make a break-even. They are open to make profits. Let's set target profit $7,500. To ensure this target profit, contribution margin should cover both fixed cost plus target profit. The formula should be the following: fixed cost plus target profit divided by contribution margin. Fixed cost is $11,000, target profit equals $7,500, total would be $18,500. When you divide $18,500 by contribution margin, that is 5.63, you will know that 3,286 cones to be sold to get the profit of $7,500 means you have to sell 109 cones in a day and 14 cones per hour,